Welcome to our podcast. This is Friends on Fire.
I'm Mike. I'm a lifelong devotee of financial independence. I even wrote a book about it.
And I'm Maggie, a newer convert, but just as passionate, especially on the intersection of minimalism and financial independence.
We're one and the same.
We are two like-minded friends who believe that talking about money with your friends and family opens the door to financial well-being.
The Friends on Fire podcast is about dispelling myths, building financial acumen, and sharing your financial independence journey with the people you care about.
This is Friends on Fire. Hey, Maggie.
Hey, Mike.
How's it going?
You know, living the dream.
I can't tell if you are in a good mood or not.
I'm in a good mood. There's a lot to be thankful for. I'm having a... You know, when I say living the dream and like, oh, I'm trying to have perspective, there's so much to be thankful for. It always means that there's like a lot going on. It's just it's a busy day. There's a lot going on today.
All right. Well,
but you know, I'm always excited to talk about this.
yes. And we are going to continue what I thought was a fun episode talking about home buying.
Riveting.
Yes. Now, before we do, coincidentally, somebody sent me a TikTok video where, and I still, for the life
Do you even
of me-
know what TikTok
no,
is,
I
Mike?
don't. I think it's like short videos of people dancing, but apparently like people also
All sorts
like,
of things.
give advice and stuff. So
Dancing, pointing to different things on the screen while
Yeah,
they
I don't
awkwardly
understand it. I'm not on it.
rock about.
But she sent me this TikTok video, and it's this guy who's saying that you can save money on your mortgage by like getting a lower down payment and then paying the down payment in your second month. And she was like, this looks,
That sounds confusing.
It
I'm not even
sounds
following
scammy.
that.
and I was like, and just watching this video, I'm like, this guy does not look legit. What he's saying doesn't make sense. This is a scam. And then I did the math, and it turns out he's actually right.
What's he talking about?
So what he is saying is that if you make a large down payment and then get a 30-year loan, let's say, your payment amount, which if you remember the last episode we talked about, is going to be fixed every month for 30 years. That payment is going to be for the entire period, 30 years. But if you make a lower down payment and then very quickly pay the additional amount as a lump sum, your payment remains the same, but you have since reduced the total number of payments you're making. And so what happens is the interest over the term of the loan is less because you have shortened the time period. I can see by your face this doesn't make sense.
Well, I hear you. What were you gonna say? What were you gonna add?
Well, I made the exact same face. I was like, this doesn't make sense. Wouldn't it just be the same? But until I actually modeled out pay down amortization schedule, it didn't occur to me that this was actually correct.
Huh. I think I need to see it in a table. But
Yeah,
I
will
always
show it to
like
you.
new tips, and it turns out there is good financial advice on TikTok.
Yes. So that is the lesson here. Not everything you see on TikTok is going to be bad advice. Even if it
don't
looks like
judge
bad
a book
advice.
by its cover. Just because somebody's like dancing around awkwardly and pointing at words on the screen, which is 90% of like any self-help TikTok videos, at least.
Yeah.
I just like the straight dancing TikTok videos. The ones with advice, I'm always like, this is a little bit awkward. Look, I made one for Friends on Fire. Remember, I made one TikTok video,
Mm-hmm.
and it was of my husband cutting his hair with the Flowbee. It didn't go viral like I thought it might. Okay, so we're talking about TikTok today?
No, we're going to continue our conversation about home buying. And just to catch us up, I thought we'd listen to this voicemail again.
Hey, Michael and Maggie. I am trying to figure out whether to buy a home or rent an apartment, and we could really use your advice. Everyone keeps telling me that I should take advantage of the low interest rates and that now is the best time to purchase a home in my entire lifetime, which is kind of terrifying. However, when I'm looking at the market and what's available, it's mostly, smaller townhomes. Pretty much all the single-family homes have been snatched up. There's not really a lot out there, even for what is there. So the market seems pretty frothy and like it's reaching a peak. And I had always been taught not to buy high. So seems kind of at odds with the advice as well. And I'm just trying to figure out the pros and the cons of the situation. Some other pieces of information towards it. I have enough for a 20% down payment and would have someone who would be probably renting from me as well as a roommate, assuming that I find a home in the right area that would be convenient for us. So thanks in advance for any advice that you can give on how to make this complicated decision.
We would encourage you to listen to the last episode if you didn't already. But the 3 key takeaways from that, as we kind of introduce the idea of how you should think about home buying, are, number 1, it's a lifestyle choice, not an investment choice. Number 2, you should buy a home for the right reasons, such as the reasons that are important to you, not what you think other people would want. And then number 3, expect to pay a ton of money over time, but if you pick a house for the right reasons, you won't regret it. So if you didn't listen, we just caught you up.
And so if you've decided that you are ready to make what we would call a lifestyle choice, not a financial decision, to buy a home, we want to go through some very tactical advice and tips for how you do it in just so you understand the process, but also so that you can do it as cost effectively as possible.
And Maggie, you and I have bought a number of homes.
Yeah, my vacation home in Maui,
Yeah.
my Colorado ski chalet.
Oh God, I wish.
I'm just kidding, by the way. I don't own any of these homes.
But we have gone through this process a bunch of different times. And so we are going to share our thoughts on this based on our own unique experiences. One quick recap item. The house should be in an area that is also desirable by other people. This is not to say that you should be buying a house that is going to make someone else happy, not you happy. It still needs to qualify as the right lifestyle choice for you. But if you buy a house that nobody else will want to live in ever, it will not appreciate, and it will end up costing you much more than it otherwise would have.
And Mike, on your comment there, I've never had the pleasure of doing this, but I've seen many friends do it over the years. People who buy a house in a up and coming area. So there's this thing in Atlanta called the Beltline. And it used to run through a lot of areas that weren't so desirable and did not have high property values. And people who could kind of see that was coming and or just were buying in that area because that's where they could afford, their houses are worth 4 or 5 times what they bought them for.
Yeah.
In just a matter of 5 or 6 years. And so there's also, there's a lot of people who will purposely buy in an area that is still up and coming because they want to ride that appreciation wave. And, more power to you if you, think that that's your strategy and approach. And it works for where you want to live at the time also.
Right. Yeah. You don't want to be unhappy living in your house for 10 years, hoping that for some reason the area turns over and becomes super desirable. You should be buying it because it makes you happy from day one. All right. So let's go through some specific stuff about how you go through buying a house. I think the first question that people are going to want answered is, how do I determine how much I should be spending on a house? And to do that, there's 2 pieces. One, what does your loan look like? And what does your cash flow look like? So let's talk about first part. First thing you should do is just contact a bank or a mortgage broker and see what rates are available, see what your credit score will allow you to borrow. This is not to say that whatever they give you is what you should spend on a house. It is just one data point you need to make the decision.
Mike, let's break that question down a little bit for people. So when you say contact a bank or a mortgage broker, one thing, and then I'm going to ask you a question, but one thing is often your realtor, if you're working with one, will have a mortgage broker that they trust and have worked with for a long time and that they'll recommend. That's usually who I go with. Sometimes you'll have someone that you've used before. But a mortgage broker can help you because they're shopping around at lots of banks versus a bank is just going to give you their rates. So if you're part of USAA or credit union or something like that, you might want to consider your direct bank. But I wouldn't go to the average bank directly. Would you, Mike?
I did.
You did?
Yeah.
Really?
Yeah. So
how did you know you were getting the best rate?
I didn't. So here's what I did. And we actually might have some different advice. But I think the point of it is that you can have different approaches and still end up making good decisions.
Yeah, that's true.
There are a bunch of different things that you could go do. Mortgage brokers, websites like Rocket Mortgage and all these different things where it will shop around for you. Or you just go to Charles Schwab that I have for my brokerage firm, or Wells Fargo, which is my bank account, and they will offer mortgages as well. The rates are going to be slightly different. Like a Schwab is probably going to be slightly more expensive than the cheapest thing that you can find through Rocket Mortgage. But what I have found is that you will make yourself crazy if you go scouring the internet to find every basis point of savings that you can on your interest rate. There are other factors which are important in getting a mortgage.
I do agree you will make yourself crazy, but I also think a mortgage broker can be very helpful because they do all the work for you. You don't even need to consider any of it. And I think their fees are like nominal, which I know you agree with in terms of just some of those little fees you're not super worried about. You're more worried about like getting the right house and all, and putting, the right amount down and all of that. I will say I've had really positive experiences with Quicken Loans before, which is that Rocket Mortgage? Is it the same company?
I think they're both the same company, but different services.
Okay. Well, we've used Quicken Loans before. The only reason I haven't used them on like recent rental properties is because I was in a hurry and I needed a faster process than they could provide. But they have really competitive rates, great customer service, really slick, like all online technology that they use that I was very pleased with personally. I also have had really good experiences with mortgage brokers. And so if you find one that you like, and again, your realtor will often have one that they would recommend to you. You can also, a lot of friends will refer one to you. So I do agree with Mike in the sense of like, I don't love going directly to a bank, but I also wouldn't go crazy worrying about like where you get your mortgage. I think you can't go wrong going to a reputable bank or through a mortgage broker.
And I think this shows the vastly different experiences that you can have, because on my primary home, I went through a whole bunch of like online things and eventually just got a loan through Wells Fargo because I found the work they were doing on my behalf and just their process and closing on the house made my life a lot easier because I had a lot of other things to do. The rental properties that I bought in Atlanta, we have used Bank South, which is not the lowest interest rate we could get, but the service they provide and the process for us is so easy and stress-free that is what is important to me. It's not the 5 basis points of interest rate savings. So just going back to what we said, don't make yourself crazy about it, but do some research. You need to understand what options are available to you. One additional thing just to highlight about the loans and the fees is that lenders will have this opportunity for you to quote unquote buy points. So buy percentage points or basis points off of your interest fee. And the math is going to appear super complicated. It's basically you pay something up front and then you will save money over time because you're paying a lower interest rate. Maggie, you and I were working on some examples with your rental property, and we were doing the math. And honestly, it's all sort of a wash. So my rule of thumb is if it's like so complicated that somebody can't explain it to you in 20 seconds, it's probably not in your best interest.
Yeah. And the deal with points in general that is important for people to understand is you are basically making a trade-off between how much you pay now versus how much you pay later, right? So Mike did like the detailed math on this and it was a nominal difference where it was almost like just pick your preference. You're not losing or saving a massive amount of money either way. But the idea is in this example, I was having to pay an additional $2,000 at closing, which is cash upfront, to have a lower interest rate over the next 30 years. And for me, I didn't have the problem bringing the cash to closing. So in theory, you'd think like, oh, well, I'll do that and I'll get a lower interest rate. But I don't know that I would have this property for 30 years anyway. So there's just, you really want to kind of just think through it for yourself. But I thought, Mike, I was actually, when I asked you about it, your opinion on points, I was actually fascinated that you kind of were like a little like lackadaisical about it. Like you were just like, I don't think too hard about this stuff, which I thought was interesting because I just didn't expect that. I would have thought you like immediately, had a very strong point of view on it one way or the other. But I did agree. I came around to understanding what you just said, which is it just doesn't make it's a difference in when you pay the money, and you could sit there and overanalyze it, but like you're not talking about a massive amount of money compared to the overall life of the loan. Focus more on how you get into a 15-year mortgage and save that, $250,000 in interest that we talked about. And I kind of appreciated that, like, a lot of your financial points of view are kind of more focused on like the bigger picture and like getting the right house that's a good deal and not worried about the, saving $100 on this fee here or there.
Now, the other piece of this is understanding what your cash flow is. And so once you apply for a loan and you kind of like give them an idea of how much you're looking for, they'll show you what your monthly rate is going to be. And this will include the escrow account to pay for insurance and taxes and that sort of stuff. You need to then take that and compare that with your cost of living. If you are not tracking your expenses, we have a wonderful Excel document on our Etsy store you can download and keep track of this. But you absolutely need to understand how much money is coming in and going out, because as we mentioned last week, the bank does not care. The bank wants you to borrow as much money as possible because that's how they make money. So you need to make the determination about how much you can afford based on how much money you have coming in. Yeah,
the bank is not focused on your savings rate or when you'd like to retire or what any of your personal finance goals are. The bank is going to loan you as much as they are legally allowed to based on different government regulations that are now in place, because banks once loaned people way too much money, which is what happened in 2008 with the stock market or the real estate housing market crash, excuse me.
Once you get a monthly mortgage payment number back and you've looked at your monthly expenses, one thing that I really want to stress is that you need to be able to comfortably pay this each month. So if you have a mortgage payment of $1,500 and you're like, well, if it was $1,600, I'd be in real trouble. If it's that close, now is not the time for you to be buying a house, or you are buying a more expensive house than you need. You need quite a bit of buffer because you will always have unexpected expenses, which are going to make your life really hard if you can't pay your mortgage every month.
Another factor that you want to think about is just thinking about your future costs as you think about, your cost of living. So things like childcare, if you're buying a home before you have kids, which many people often do. I think that is just one example of something that we cannot stress enough, which is do not max yourself out on your monthly payment, right? Things unexpected come up. You need to save for, if you're going to have children, if your car dies on you tomorrow, right? All of these other things that could happen, like do not have yourself so kind of leveraged to this massive monthly payment that you're just stretched too thin, because it's like a lot of things we talk about with money. Like, it is not a good feeling to be stressed about how you're going to make your next monthly mortgage payment, right? Make it easy, make it something that's affordable. And if you can't do that, I know you don't want to hear this, but you may not be ready to buy a home. And that's actually what we talked about on our last episode, right? There's nothing wrong with renting. Lots of people rent. You can still rent a home. You can have it feel, less like living in an apartment or a condo or whatever. If you're stretched on this as you start to actually look at the numbers, it might be a sign that this isn't the right time for you to do this, and that you need to, spend another couple years saving and getting to a better place to be able to purchase a home.
As you are applying with different mortgage companies to get a loan, you're going to have an option on terms. And almost everybody is going to be looking at a 30-year term because that is just common in the industry, and it keeps your monthly payments as low as possible. So the longer you spread out a loan, the lower amount you pay each month. The shorter your term, the higher amount you're going to pay each month. But this is to the bank's benefit, not to your benefit. So we'd actually recommend getting as short of a loan as possible on your primary residence, because unlike a rental property, which you borrow money and then it generates money in excess of what you owe, for your primary residence, you borrow money and then you pay a cost to live there. And if you remember in our last episode, we went through all of the costs that Maggie and I have incurred over the past 10 or 15 years in our homes, and it's extraordinary. And so you want to be reducing the amount of interest you're paying over the life of your loan by as much as possible. So if they don't give you an option for a 20-year loan or a 15-year loan, you should ask. It will come with a lower interest rate. That is one reason you would want to do it, but you're going to pay less in total interest, as I mentioned. So let me just give you some numbers for what this looks like. On a $500,000 loan at 5%, your monthly payment, this is just principal and interest, so excluding escrow, which handles your taxes and insurance, you pay $2,684. Of that, only $601 goes to paying down the principal. The rest, over $2,000, is just interest, and that's in your first month. Now, over the course of 30 years, you would pay, on a $500,000 loan, 5%, $466,000 in interest. Almost the entire cost of the house in interest. Now, if you were to do a 15-year loan and get a lower interest rate, we'll call it 4.5%, you would pay $188,000. That is a savings of $278,000 in interest because you have gotten a shorter loan.
Those are the things. That is the power of being able to retire earlier, right? Making decisions like this, like buying a house that you can more reasonably afford, that's not out of your price zone or price range, and doing something like a 15-year mortgage, that $277,000 that you're going to save over the next 15 years, that can fund 5 to 10 years of your life in retirement, especially when you no longer have a mortgage, right? And so these are the like power moves that are so important. And if you're not, I mean, the other thing I would say is if you're not to the point of feeling comfortable enough to do a 15-year loan, you can take a longer loan. You can take a 20-year, 30-year loan, and then you can really aggressively pay it off, right? You're not going to get the benefit of that lower rate with the 15-year, but you will have a lot of interest savings.
Mm-hmm. That's right.
Which is it's a backup option. It's an alternative to like if you just can't swing the required payment that's on a 15-year loan and it makes you super nervous for some reason.
And you could refinance. So if you get 5 years into your 30-year loan and refinance to a 15-year, you still only have a total 20-year loan. You're going to pay less interest over time.
Yeah. Let's talk about two quick things real quick. One of my pet peeves is when people tell me that they've refinanced and they've gotten a really good deal and like, oh, I lowered my payment, blah, blah, blah. And I'm like, hey, you're like 7 years into your loan. You just refinanced for another 30-year loan. You've now got a 37-year loan.
Yeah.
Right. You've just dragged this out. So that lower payment is incredibly deceiving. It's trickery in a lot of ways. You're just now going to pay more interest over the life of 37 years now instead of the 30 years. So every time you refinance, you restart the clock, right? Now, if you start the clock shorter, like you're 5 years in and you do a 15-year, that's great. You've just taken 10 years off your 30-year clock. But every time someone tells me that, I'm always like, okay, I don't want to be like an asshole to your good news of your lower rate and your lower payment, but like you've just now dragged out your loan even longer. The other thing to add to this, Mike, that you just mentioned briefly is let's just briefly talk about taxes and insurance because you mentioned escrow. And so just explain to people what escrow is and what some of those charges are, because I think when people are thinking about budgeting, they also need to think about that. Usually a mortgage broker or the bank will walk you through this, but it's helpful to understand up front when you're budgeting these things because those can be a big chunk of a lot of mortgages.
Yeah. If you live in a high tax area, taxes will be a big part of your monthly payment. So escrow just means that you pay an amount to the bank and then the bank holds some extra cash in escrow and then pays on your behalf your property taxes and your insurance. They'll pay it directly to the city or the state, and then they'll pay it directly to the insurance provider. So if your monthly payment is $1,500 of principal and interest, and then you have $300 a month in taxes and insurance, you would pay $1,800 to the bank. The bank would hold the extra $300, and then when your other payments are due for taxes and insurance, pay those on your behalf.
And I think what's important to understand there is a lot of times you don't have a choice on this. So usually when you get a mortgage, a bank will actually require that you roll in your annual real estate taxes and then also your homeowner's insurance into escrow. I've heard that like in the first couple of years, you can actually pull it out if you want to, but like when they do the mortgage, they want it all together because they want to make sure that that's paid and that you fully understand, what those full costs are going to be. But you're essentially like in our area, I don't know about you, Mike, but like my real estate taxes are about like $5,000, a little bit more a year. I mean, it's over $500 a month, right? And so when that's rolled into a mortgage, essentially I'm paying the bank $500 a month. They're holding my money throughout the year. And then at the end of the year, when my once a year annual tax bill is due, they're paying that money for me. An interesting thing I learned in looking at real estate, rental properties, Mike, too, is a lot of people actually lose their houses over real estate taxes.
Really?
Because they're due once a year. Yeah, I learned that certain people, like people that are trying to buy up rental properties, this is not my strategy to be clear, but actually check the county. There's some way to check the county's late notices. You can see them individually on a property. Like I just bought a property that I could see that the 2 owners ago had not paid their tax bill. And that's how this like flipper got the property. But when you can't pay your taxes, like the county puts a lien on your house. And, you know, if you have a $5,000-$6,000 tax bill, like that's a lot of money to people to have to come up with all at once. So if someone's lost their job or, you know, you've had other things happen, that can be a reason that sometimes people can no longer keep a house, which is kind of sad. But again, that's why banks roll these costs into your mortgage. That's why they hold your money in escrow and then they pay the bill for you.
So one more point just to close out the loan details before we get moving on the rest of the home buying stuff is that, you know, there's this term, this is also a pet peeve of mine, Maggie. There's this term good debt that kind of floats around in marketing and mortgage, not good debt. Good debt is something where you borrow money and then make a lot more money from it. That's called leverage. This is just debt. Like this is a cost. It's going to be huge and you're going to have to pay it. There's really no benefit other than being able to make the lifestyle decision to go buy a house. So treat your mortgage as a cost and do everything you can to get rid of that cost as soon as possible. It's a power move, as you described it, Maggie. I really like that.
What's a power move? Oh, getting a shorter mortgage. Yeah.
It's
when
this
you said
thing
that,
you
I was
just
like,
said.
what's a power? I was like, did I say power move? That sounds great.
Yeah,
it is a power move. Yeah.
You had a great saying and then forgot you said
we should name an episode sometimes, Pet Peeves and Power Moves.
Oh, I like it. Okay.
Where we talk about like the things that drive us crazy, but then all the power moves that make us happy.
Yeah.
Stay tuned for that in Q2 of 2021, folks.
Now, on the note of bad debt versus good debt or leverage, one of the things that the listener said in her message was that she's considering renting out a room in the house. And so this is kind of a mix of your primary residence and a rental property. And there's a term for this. It's called house hacking. And we did a fun episode with Andrew Kerr, episode 18, where he took us through a whole bunch of different house hacking ideas, the one of which was buying a house you live in and then renting out a room or part of it. And so if you can generate some cash, that's awesome. Then this becomes kind of a mix of a cost and an investment. And it lowers your total exposure for buying the house. So if this is an option for you, especially like if you're young and flexible to do it, you should absolutely house hack. This could make you a ton of money.
This is something I wish I had. I think I said this when we talked to Andrew. I wish I had done this when I was younger before kids. I think it's a lot harder to do when you have kids if you don't have like a in-law suite or a private area in your home. But gosh, I wish I had done it when I was younger. Would have been fun too, you know, with the right people.
Yeah. So moving on. Once you have a good loan strategy in place and a good lender, consider what work the house needs and if it adds value. One of the things that I think we are conditioned to think is what we get from HGTV and House Hunters, where people enter a house and immediately start listing off hundreds of thousands of dollars of renovations that they just want to go in and fix. This is all crazy. Now, it is good to go in and do some fixes if it adds value or if it makes your enjoyment of the house a little bit better, but don't overdo it. Here's kind of the example that I like to give people. If a house has a modern kitchen, but you don't like the color of the granite, this is not the type of thing that you should go in and renovate because you will add $0 in value to the house, but it will be a pretty big cost for you to go do. Look for things that really need improvements to bring the house up to the standard of the neighborhood that add value. Don't just go in and make a whole bunch of aesthetic changes because, you know, you like gray and the walls are white or whatever.
Well, this is also back to it being a lifestyle decision, right? So if what color countertops you have is critically important to you, you're right. If you buy a house that has an updated kitchen, but not one you like, that might not be the house for you because you're going to lose a lot of money when you put that in. Go buy a house with a crappy kitchen that already needs to be updated because you're getting the discount on the house because the kitchen's old. So that's actually a great point because I'm Mike, you are so, what's the word for you? You are so unemotional about these decisions, right? Like you don't really care what the countertop necessarily looks like. I think that's true.
I do, just not nearly as much as other people do.
You're right. That's a good way of saying not as much as other people. So you don't care, but like it matters to a lot of people, which is why it can still matter to you, but you can still be smart on how you incorporate that decision. Like using that kitchen example of like, if it is critical to you that you have a kitchen that looks a certain way and you're not finding one in the houses that you're looking at, well, then find one with an old kitchen that needs to be redone anyways, right? Because otherwise you are literally just throwing money away at that point. And if you're in the question of, whether you can afford a 15-year loan versus a 30-year mortgage, if you're on the fence and you're like, well, I'm not sure if I can quite swing a 15-year, but I really need that new kitchen. Like that's when you might want to be thinking about just your priorities and your broader goals. Again, not to judge like all of these things. I've seen this a lot on social media and I actually love it. It's personal finance. The word personal is in front of it. This is not finance. This is not like, you got to deal with a corporate finance guy like Mike at work every day who's, telling you what you can and can't do. This is your decision. It is personal. So make the decision that makes sense for you. We're just trying to give you some encouragement on what would help you financially down the line when we give some of these recommendations.
And let's say you do find a house and the kitchen has been redone, but it's not to your aesthetic. When you are ready to go make an offer on that house and you know that it's going to cost you $20,000 to redo that kitchen to your liking, this is not an opportunity to reduce your offer by $20,000 because you're going to have to put it in. That price has already been baked into the market. That person made the renovation. The house is now worth more. And if you want to replace the kitchen, that's on you. You're not going to get a discount on the house because it doesn't work for you. Assuming that the kitchen was done to appeal to a majority of buyers and they'll get other offers. But just keep this in mind that your personal changes are not an opportunity to go get a lower price off the listing price. Now, Maggie, I'm interested in your thoughts about this. I think it's important to put in a competitive offer on a house and not try to lowball too hard. But I'm interested in what you've done in the past.
This is one of my favorite topics because it's the art of negotiation, right? So it depends what you have to lose versus what they have to lose. So it depends who's in a position of power, which is important, right? Mm-hmm. Like if right now it is a seller's market. Is that the right word for it?
Yeah.
I was to make sure I didn't have that the opposite. Yeah, it's a seller's market. Things are going crazy. Homes are selling at prices, like at least in our area, where realtors are shocked by what people are getting for their homes. And I'm hearing about it like all across Atlanta. I mean, homes going like a couple $100,000 over what they would have just a year ago. Mm-hmm. And so anyways, it's a seller's market. The buyers do not have a lot of room to negotiate. And if they try, someone else is going to beat them. So in markets like that, you got to kind of decide, like, are you willing to lose this house over a couple $1,000s? So this just happened to me on a rental property we're buying now, Mike. And my realtor was giving me good advice. And he was basically saying, like, I mean, you can negotiate with them, but like, you're not going to get this house. So decide if you want it or not. Mm-hmm. And he was right. I mean, there was a couple areas where like we knew to push and didn't know to push. And so, if you have a good seasoned real estate agent, which you can probably just tell based on like their number of years of experience and kind of how you're dealing with them or your experience with them. If you have like a new green real estate agent is when I wouldn't trust their advice in negotiating and like when to push and when not to push. But typically you want to work with an experienced realtor because this is what they do all day long. They're good at it and they have a good sense of like sussing out the other realtor that they're working with to kind of understand like how flexible they are or aren't. So to me, there's no way for me to give brief answers to any of your questions, as you know, Mike. To me, it really is just understanding how much you have to lose versus how much the person you're dealing with has to lose. So, and then based on that, deciding how hard you want to push. Like there's situations where I love to push really hard and see how hard I can go. And I'm willing to lose it and walk away. Or I know that they're never going to walk away. And that worst case, they just say no. And I've kind of offended them. But then in the end, we're going to come to a number anyways. Versus there's other situations where, again, I know I'm in a competitive situation with other buyers. And I just want to like give them my best offer up front. You know,
you've made a number of great points. I'm not sure what my question was, but let me try to address some of the things you said.
I forgot what the question was too.
About how aggressive you should be in your initial offers. So first point that I totally agree with, listen to your agent. They're going to know the area very well. They're going to have done the research. Do some research yourself. Go to Zillow, look at the price per square foot, look at what houses have previously sold. These are called the comps. And you'll get a pretty good idea of what the houses are worth. It also comes down to your position of power. So if you were buying a rental property, that's a total dump and you know nobody else is going to want it, and you don't really care if you get it or not, go aggressive. Put in a super lowball offer because it really is worth 30% lower than asking price to you. But if you're buying a house because it's a lifestyle choice and you're in a competitive market, don't go in and hope that you can offer 20% below asking and they're just going to come back and negotiate and you'll land on something that's feasible for you, because this is not HGTV. This is not $1 million listing. That sort of stuff just does not happen. And right now in Atlanta, and I think in a lot of places across the country, homes are going for asking price if they're priced competitively. And if not, they're going to sit on the market for a while and the price will come down. So you just have to be prepared to live with the results of this. Like, do you want to lose this house for $2,000 or $10,000? Like, make sure you're being honest with yourself and understand what's at risk by going in and trying to game the system too much.
Yeah. And I think I love a good competitive negotiation, but I also want to be kind and reasonable. And also what you just said is, you know, like, look at the long-term view on this, right? Do not lose a house over a couple $1,000s because you're just digging your heels in. And maybe the other person is kind of being an ass about it and you're just annoyed that they're being difficult or something. Like, don't let your pride get in the way of this. This is a financial decision. And just think about, like, if that's the house that you love and it's got the right schools and the right neighborhood and everything else you want, like, in the end, you don't have to be the one walking away getting the best offer, right?
Yeah, good point.
You want the house. If that's your goal, like, get the house. And I'm not saying overpay for it, but certainly I will see that sometimes people just kind of like let their pride or their competitive nature get the best of them and they miss out on deals as a result, or they miss out on not a deal, but a house as a result. And it's unfortunate. So, you know, take the long-term view on this. If this is going to be your family home, it's a lot different if you're looking at like a real estate investment or something like that.
So after you have worked with an agent, you've made an offer and it's been accepted, first thing you need to do is do a rigorous, detailed inspection and make sure you really understand what you're buying. If this is the first time you're going to go through a house and like look at an attic and look at plumbing and HVAC, bring your parents along or bring a friend along who has bought and sold houses before, someone who can help you understand a little bit better what you're looking at. I
got a COVID recommendation of this part too.
A COVID recommendation. Like during COVID
inspection,
times?
Yeah.
Okay.
So I have heard that some inspection companies, particularly the larger ones that have like more sort of policies, are not allowing the homeowners to be on site during an inspection. I would push back on that heavily. You are about to invest hundreds of thousands of dollars into a home. I don't think you should just have to rely on a paper report. Like, a good inspector will walk you through the house and show you what they're looking at and where they see issues, and they'll explain stuff to you and they will take time to answer your questions. And especially like a first-time home buyer, but really anything, this is a huge, expensive investment, push back. Like, you have a right to be there at the inspection. And if it's an inspector that's not going to, like, again, walk you through and like let you be a part of that process, find another inspector. Tell whatever bank, mortgage company, like, they can get you a different inspector, especially if you have time for it. built in, but I've heard that from a couple people lately, particularly from one person that was buying a house. They weren't allowed to be at the inspection. And I was like, I either wouldn't have been using that inspector anymore, or I would have pushed back on them so much that they were like, fine, you can come.
And once you get the results of these, make sure that you are focusing your attention on the stuff that really matters. Like if there is a foundational issue or there is mold
to be clear,
in the attic,
you mean like literally an issue with the foundation,
yes,
not
an issue with the foundation, the concrete foundation of the house, or there's mold in the attic, or the ceiling is caving in. Like you can go back to the sellers and see what can be done as far as them making the repairs or them lowering the price of the house. But I would recommend, and again, I'm interested in your thoughts, Maggie, if you don't like the paint color in the bedroom, or there was like a chip in the granite countertop on one of the bathrooms or something, just forget it. You're going to annoy the sellers. It's not a material cost. Like your objective at this point, if you want the house, is get it at the right price. And then like, it's a long-term thing. Don't worry about these little things.
My perspective is similar to yours, Mike. I would say don't nickel and dime people. So I agree. All these little things, like fix them yourself, deal with them later. But just remember, you agreed on a price to buy this house at. And usually there was a disclosure involved that told you, how old the roof was, how old the HVAC was. So you knew the condition of everything you were getting at X price. So if you agreed to pay $300,000 for this house and you knew all these things, the only things that you really should give them a hard time about after inspection are the items that are surprises and were not disclosed and were something new, a new piece of information that you were not aware of when you agreed on that price of $300,000. So when someone inspects it and you find out that there was, like we just found out, a bunch of electrical issues. Well, then you're like, okay, well, that's new information. I did not know that this house was not up to code, right? And I did not know that I now have to spend $4,000 in electrical upgrades. And so that is a new thing, and that is a legitimate thing to go back and ask for. And so this is just like the beginning. You need to understand what your stance is in the negotiation and kind of who has the power and who has more to lose by things falling through at this point. And again, can't hurt to ask. So I agree on like not pissing them off and not kind of nickel and diming them, but it can't hurt to ask for something. At that point, you're already under contract. The worst they can say is no. You're still under contract. Even if you ask for $5,000 and they say no, they can't get out of the contract because you asked for $5,000 and they said no. You then just decide, okay, am I going to do this anyways? And the ball's in your court to decide what to do from there. That's the other thing that I think is important for people to understand about the home buying process that many new home buyers and or people that just haven't bought a home in a long time might not remember is, once you go under contract on a house, you put down some earnest money, which you get back if things fall through. The only cost that you're out is what you have to pay that you will not get back during that due diligence period is the cost of an inspection, which is usually, anywhere depending on the market, probably from like $400 to $700. And then the cost of an appraisal, which is kind of in the same price range, maybe $500 or $600, at least from what I've seen. And those are the only two costs that you're out. So you still, even after you're under contract, you have a period of often like a couple of weeks where you can still get out of that. So if you find out things that you don't like in the inspection, you're like, I can't deal with this. This is way more issues than I thought. We don't have money to deal, whatever it is. You can just get out of it and you're out your, $1,400. Do not do what is known as an escalated commitment. Just because you've now spent, that I'm just estimating, but right, that $1,400 on your appraisal and your inspection fee, being like, oh, well, I'm going to have to deal with the $40,000 in issues that they found during the inspection. You don't. You can just get out and be like, I'm walking away. This doesn't make sense for me now. You'll get your earnest money back. You do not have to continue with the purchase of the house, right? They will now try to sell it to somebody else. And I think that's an important thing to understand about this process is that this whole thing is like, you've got time. Every time a new piece of information comes in, like the inspection, you now decide, does this still make sense for me based on what I now know?
That's a great point, Maggie. Now, once you've gotten past the inspection point and maybe you've asked for something and they've agreed to it and you've amended your contract, the next thing you need to do is you are going to go through the process of actually finalizing that loan and closing on the house. So you need to make sure you have your paperwork in order. The lenders need everything. And I mean everything. And especially if this is the first time that you're buying a house, it will make you crazy how much information they need. And if you're going to get help from your parents, they're going to need a letter from your parents saying that this is a gift and it's not a loan. And it's crazy how much stuff they need. It's a painful process. There is no way around it. So just prepare yourself.
Yeah, they want to know. I'm going through it now. They want to know why this much money transferred into your bank account 2 weeks ago, right? Where did it come from? You have to sign where it came from. If you're divorced, they want a full copy of your divorce decree and parenting plan, everything, some really personal documents. Like they have to have it all. The things they ask for, I'm always shocked by. And I'm like, really? You need that? Like I have this much in like collateral. Why do you need all this other stuff? Like, right. You can see the size of, my 401k or other things that they look at for backup if you were to default on a loan. It's just funny that the thoroughness of what they want to know about you and your financial life. And a lot of this came out of the housing market crash in 2008, right? Like there were really poor regulations on what they looked at to approve people. So they were approving people for loans that shouldn't have been approved. So now they have this greater level of regulation in place around this.
So after weeks of stress, expect that around midnight on the night before your closing, you will finally have everything done and in a place where you can go to the closing the next morning and sign the paperwork. Once you get to that point and the bank has approved the loan, closing is a piece of cake. You just show up and sign paperwork. There's nothing else to do.
Yep. Hey, do you actually, a fun question for you. This will be our Mike's Minute on the Mic.
Mm-hmm.
Do you actually read all the paperwork they put in front of you at closing? That would take you hours. I just went through it recently and I was like, does anybody actually stop and read every single one of these documents? We'd be here all day.
No, I read the closing disclosure prior to attending closing to make sure that there's kind of no funny business on the fees. But no, I don't go through and do the 100 pages of like weird, bank indemnification clauses and whatever else they're putting forward for you. It's all sort of nonsense. All right. So you bought a house. Congratulations. You're all done.
They give you the keys.
Yeah, they give you the keys and you can go move in.
Now you forever get to deal with, trees that need to be taken down, garbage disposal is breaking. The joys of home ownership, people. Enjoy it. Congratulations.
All right, so let's close this out with our 3 key takeaways, Maggie. Number 1, you determine how much house you can afford, not the bank.
If we haven't said it enough, number 2, borrow money for as short of a time period as possible for your primary residence. This is going to be what saves you the most money in those interest payments over time.
And number 3, and this is, I think, contrary to the way I usually talk about money-related issues, but do your homework, but then don't kill yourself over the minutia. It will all be okay.
I'll add to your point. A 3B, yes, don't kill yourself over the minutia, but also don't be afraid to ask questions. I ask my mortgage broker all sorts of questions, right? Like it's their job to answer them. Like understand the process. If you're curious about it, like learn about it and understand it. And again, like don't stress over the minutia of it because there's a lot of things you're going to have to do and hoops to jump through to get a mortgage, but it's good to like understand it. So, ask questions. Okay. Well, congratulations if you are buying a home. Interest rates are at a very nice low right now, so enjoy it.
And thanks everybody for listening. If you've been challenged or inspired by what you've heard, please rate and review the show. You can also subscribe to make sure you never miss an episode.
If you have any thoughts or questions, as always, we would love to hear from you, and you can leave us a voicemail or text us at 404-981-3370.
And if you leave us a voicemail, we might do a 2-part episode
for you. We might do a 2-part for real. You can also hit us up on Instagram anytime.
All right. Thanks, Maggie. This was fun.
Okay. Thanks, Mike. Bye.
Bye.